Welcome to Wyckoff Power Charting. My name is Bruce Fraser, and I'm here with you today with Roman Bogomazov. Roman, welcome.
Thank you, Bruce, and as always, happy to be here.
We are going to do episode number 18. We are recording this on December 4th of 2018 to be aired on December 6th of 2018 and thereafter. So our discussion today is on accumulation or distribution, which sounds pretty interesting. I can't wait to get into this. We need to know. Roman?
Definitely, we need to know.
Let's get started.
Okay, let's get started.
Yeah. First of all, very excited to tell you that we are going to have our kickoff event for the new year 2019 on January 2nd, Wyckoff Market Discussions. And it's going to be a very special edition where we are going to look ahead at 2019 from a market perspective using Wyckoff. And this has become a Wyckoff tradition. And so the best part about it is that you're invited. It's free to attend. And we would love it if you would go to the website and sign up. So, Roman, any thoughts?
Yeah, just come join us, and it is indeed a yearly event at the beginning of the year. And if you are interested in the Wyckoff view on the markets, definitely a good place to start the whole year.
Wonderful. All right, I can't wait. Well, we have an interesting discussion today, so let's get started. What are we looking at here, Roman?
Well, the first chart that we're looking at, actually two charts, is SPX and a very long-term chart, although we're using the daily here, and also the percent of stocks above 200 moving average. We have used this indicator before. This is an indicator that shows the health of the market. And we definitely want to look at different analogs. So, Bruce, the first thing that strikes me is where we are right now. So between 40 and 25, and usually below 50, we would consider this, somewhat of a bearish or volatility territory, and we are definitely below that. And then I'm looking at where else we had this. So, for instance, in 2015-16, we were in the same territory. Then in 2011. And in 2008. If I would ask you a question, Bruce, what would be the closest analog to what you think we're experiencing right now? How would you approach this? Which analog would you use?
Well, this is really a measure of how much price damage has been done in the market. It's sort of looking, we're able to sort of look through the outer layers of the market and see what the internal conditions are. And so when the market really sells off like this, this is really the percentage or the measure of stocks that are above their 200-day moving average. And when you have a large plurality of stocks below 50%, that means that these stocks are in downtrends, and that the plurality of all these stocks in downtrends weighs the market down, and it causes the indexes to go into downtrends. I think that the parallel here, is, one that really stands out, is 2015, 2016. And I think that that's a really interesting period, and you can see that it was a big, wide trading range that took more than a year to resolve itself. And we could very well be seeing the same thing occurring here. Now, one thing I'd like to point out that we can see almost with all of these oversold conditions is notice how you have a low and then a test, which is a higher low, that forms in each one of these areas. And they can be very subtle, very difficult to see. You certainly can zoom in and look closer, which we kind of will here in a minute. But that's what we're doing right now, is that we have a low and then a higher low forming, which gives us some reasons to think that we should have tactical plans for the possibility that this market could pivot up from this oversold condition. Roman?
Yeah, and I'm thinking that in different contexts, this type of rally could have different price structure. So, for instance, in 2015, when we had that type of divergence, high or low on the percent of stocks, and then a divergent, well, actually, maybe even a confirmation here, or a slight divergence, we had a really good rally up. But then look into the context of the bear market in 2008. We had the same type of high or low test. And then on the percent, we're seeing a really, really significant rally. Yet on the price action, it was comparative to what we've seen before. It was not that great. And Bruce, I'm thinking this is just the context definition of either a bear market or more of the rotational model.
Mm-hmm. Well, we're looking at a situation here where we have a long period of time where this indicator is making lower highs. And so there's a lot of time that's been spent with deteriorating momentum. And so each one of these lower peaks is a sign of that. And then eventually it gets resolved with a downtrend of some magnitude. We have been in that experience right now. And now the big question is whether or not we can stay above the January, February lows of early 2018, or whether or not there's going to be a breakdown. And your analog, which goes back to 2007, with that rally attempt, shows 2007, 2008, shows that we're about in the same area of oversold now as we were then. So it's going to be very interesting for us to gauge if there is a rally here with this divergence is forming. It's going to be very interesting to see the quality of the rally that comes here, which could be very telling.
One more thought, Bruce, on this. I'm thinking, you mentioned this analog right here from 2008, and I'm thinking, again, it's very crucial for us to identify the context and then to maybe even talk about different scenarios, right? So we mentioned in scenario number one, could the price overcome the latest bar? And for some reason, I don't see this bar, but today's bar was, quite significant to the downside. Could we overcome that and under the scenario number one, have that rally that will be shown to us both on the momentum and also in price? Or would we have the context where, maybe under some bearish scenario, we're going to have some kind of trading range, and then if into the end of the year we have some sell-in, then just a total collapse? And we definitely have enough catalysts right now in the market to create that type of general capitulation where everybody just want to get out. So I wonder, which scenario is going to happen. And obviously, for that, I think that we need to look at the short-term picture as well.
Well, let's do that. This is such an interesting chart because this is the same idea as the prior one. The difference being that we're looking at stocks above their 50-day moving average. So we're looking at a shorter moving average, much more sensitive, and therefore we can see divergent behavior much more effectively on the shorter term. And so we can use this for like trading tactical analysis. And so you can see here, look back at early, look at February and March. We have a low in the indicator. You read it pretty much the same way as the other one. It's just that it's more sensitive. Look at the higher low. So you have a higher low from the February low to the late March low on this indicator. And then look at how the market, when it came back down, tested it. It also made a higher low. But it was saying that the number of stocks that are below their 50-day average is shrinking. And that is a positive divergent behavior that says that stocks are being bought and held up at a higher price above their moving average. And so more of them. And so here's a setup for a potential rally. We have a similar thing happening now where we have, look at this, we have a low and then two higher lows. during this period. This is a reason to have in mind that the market may be repairing itself internally at least enough to be able to have some kind of a shorter term rally. Now, it may not happen right away. It may have to wait until we get into the new year before it can happen. But as long as this divergence keeps manifesting itself, this is a condition that would cause us to be somewhat bullish in our tactics. And my view of this is that what we do tactically with our portfolio is, because there is the potential to go down and make new lows in here at the end of the year, is to just trade very small. If you see an opportunity where the market starts to pivot up and shows some bullish bars and wants to keep rising with this indicator, is just trade very small and then have, you know, really good stop placement. And if you're a short seller and you're committed to the short side, you're on alert now because you're seeing that internally the market is trying to repair itself. Ramon?
I like these analogs right here. They look somewhat the same. They're both creating the apex formations, and usually apex formations is all about waiting, being inactive, you know, having some doubts as to how to commit their portfolios. And I'm obviously talking about the money managers with a lot of money. So they are waiting.
Yeah.
There is not a lot of this happening during the apex formation. And apex formation could resolve itself in a different way. It could resolve itself as, you know, a continuation pattern to the upside. But please note that we have such a strong bullish sentiment on the way up. The sentiment of institutional money here is so much different than the deteriorated sentiment that we have right now. So they're much faster in selling their positions, especially closer to the end of the year, than they were, you know, back then at the beginning of 2018.
Yeah, the end of the year could really put some cross currents in this market, and that's the reason we have to be really careful and be, you know, low to the ground, is because there is a tendency for institutions to want to do some window dressing into the end of the year, and that window dressing could be to sell down positions that are not working for them, and they may actually exacerbate the trend into the new year, which could create a better opportunity for buying or trading opportunity that could develop in the new year. It's just too early to tell.
Bruce, I guess our message here, as you've mentioned before, is just be very cautious, you know, trade technically and trade tactically, and try to choose the areas of outperformance and underperformance where the stocks are really showing that they either could outperform the market in such environment, or they are in line with the volatility of the market, and some of them are being sold off. So I guess, you know, we could be in both camps.
Absolutely. And we want to know, we want to have an objective way to be able to identify, you know, what has the potential to work well on the upside and where the risks are higher for further declining prices.
Should we look at that?
Absolutely. Let's get to it.
All right. So let's start with the first chart, and that is the chart of the industry group, which is the auto parts. And Bruce, what do we look at here? What is the current trend, and how do we define that trend?
We work really hard at trend following methodology, and we do a lot of work in this area, and think it's like one of the really important ways to be able to compound money. And now, in this particular case, we just saw when we looked at those indicators that the vast majority of stocks are below their 200-day moving average. That's the environment that we have to work in. And so we want to make sure that we're in the stocks, in the groups that are behaving correctly in a proper uptrend, and then avoid the ones that are in a proper downtrend. maybe it's an improper downtrend, I don't know. But here we can see that in the case of this auto parts index, that there's this robust uptrend that started back in early 2016. And you can see that the relative strength begins to go into an uptrend in 2017, and it gets into a rising trend. The relative strength stays above its rising moving average, and the price is above its rising moving average. In this case, we're using 39-week. You might choose something different. But the notion here is the idea to keep in mind, and we're going to talk about this more in the future, is that when the relative strength line is rising on a long-term basis, this is telling institutional money managers that this particular trade, this particular theme is outperforming the market as a whole, because we're using the S&P 500 as our benchmark against which to measure relative strength. So our purpose is to always own stocks in groups that are above their rising moving average. And you can see that if the price is also rising and above its moving average, two things are happening that are important to institutions that are important to us. And that is that on an absolute basis, this investment is creating returns because it's above its the price is above its rising moving average. It's also outperforming the market as a whole by being above its rising relative strength line. And so those two conditions together are important to us because they're important to institutions, because stocks that stay above their rising moving averages for price and relative strength are stocks that are going to keep getting investment from institutional managers. And so they're going to keep getting the love. I like to say they're getting love from the institutions. And so let's look at some other examples. So now the other thing here is, let's just point out in auto parts about, look at the turn. So now we have price turn below its moving average, and the moving average turns down. And look at how that caps the price and keeps it, it's now gone from being above it for a long period of time, and now it's below it. But the other thing is, look at the relative strength. The relative strength is doing the same thing. So now the feedback that institutions are getting is that this is no longer creating performance for them. It's no longer creating absolute returns for them. They're going to start to sell down this position. They're going to keep selling it down as long as they're getting the feedback that this is an underperforming theme. So let's, Ramon, any thoughts before we move on?
No, let's go to the next one.
Okay.
So we're looking at the group. Let's look at the stock in this group. And this particular stock, Bruce, is actually outperforming the group because instead of being under the moving average, it's above it. And then also on the relative strength, we see in the same picture. So how could this be?
This is an important idea, because what we're saying is that not all stocks march to the group. Some stocks, especially important stocks, and GPC, genuine parts, is an important stock in the group. In this particular case, this is leadership, and you can see that there's the potential for long-term accumulation in this particular stock that goes back years. And so this could be a huge upward potential. The key that we see here is twofold. One is we want to avoid the stock as long as the relative strength is in a downtrend below its declining moving average. And so we can see that taking place here. Look at the persistency of that decline. It just goes and goes and goes. There's about 1.5 years of this. And so we want to avoid the stock until it starts to have relative strength uptrend, which you can see that now in 2018, genuine parts is now above its rising moving average for relative strength and price. So they're in gear. This is an in gear situation, price relative strength. Genuine parts is giving institutions positive feedback that it's working. It's a theme that's working, even though it's in an industry group that is not working right now. So that causes us to be a little careful, but this is exactly what we're looking for. And this just points out that we want to find stocks in groups that are working, but also we recognize that there's going to be discrepancies inside of the groups. So, Ramon?
Let's go to the next one, and this one is outer leaf and also outer parts. And here, Bruce, a different picture. As you have said, you know, stocks in the same group could have different structure, could have different absolute and relative performance. We're seeing that the price is under the moving average. The relative strength has been in the downtrend, then has been in the uptrend, and currently is under the moving average as well. So in sync with the underperformance by the price.
And look at that beautiful uptrend. When it does finally get in gear up, you have a situation where it goes for more than a year in a very robust uptrend. Look how beautiful that uptrend, it just persists and persists. And then notice how we can put our Wyckoffian hat on and do the distribution analysis at the top and the reaccumulation analysis that Ramon is drawing. So Wyckoff becomes very important at the important turns. And so now we have a confirmed downtrend on price and relative strength. And so this is a stock that we, you know, want to keep an eye on, but right now it's a theme that is not favorable.
Okay, well, let's look at something that might be that might be not favorable either, you know, in the long run, but short term, I wonder, Bruce, what are you thinking about this particular group? This is a home improvement. We had a climactic run, change of character, upthrust, and now we're seeing that there is an increased volatility. Volume is increasing, supply is increasing, and we're back at the support level here. And using the same method that we've been talking about today, the price is under the moving average, and then the relative strength is also in sync with that.
Well, so, and the idea of our discussion today is to introduce you to this concept. So it's not so much about specifically recommending any one theme or idea. We want to develop this as an idea because we're going to keep coming back to it because it's important to us. It helps us in our analysis. And here you can see this beautiful, robust uptrend that goes all the way back into 2015, goes all the way back to the beginning of the chart. And so we have rising relative strength, we have rising price, they're above their moving averages, they look great, but now all of a sudden, change of character. Look at the pivot off of that upthrusting action there, which is an upthrust after distribution. So the way they occur, they just become persistently weak on volume, and look at the relative strength. Now the feedback that institutions are getting from this prior favorite theme is that it's not working anymore. And this could persistently be an underperformer for months to maybe a year or more. And so this would be a theme that we'd want to be very cautious about. And also look at how it's behaving here. It doesn't have any lift in it. It's just hanging out as though it's under the ice, which is a Wyckoffian term. And so we want to be very careful with this, and we can see pretty early on that there's weakness here that could persist for some period of time. So Ramon?
Very interesting. Yeah, very interesting spot, just because how the group performs relative to the market, it's close to the support. So if it's going to break to the downside, imagine how many institutions are going to start selling this as the price underperforms and the stock underperforms relative.
Look how big that distribution structure is. It's huge. And so we're going to talk more about how to buy pauses in the uptrends. So we're going to get into the tactics for how we can use these really powerful tools to help us to pick the spots where we want to initiate and add positions to our to these themes, because they just keep working or they stop working, and for people that want to participate in the downside. So, and then we have an example here of Home Depot.
Oh, yes. Mm-hmm.
Yeah, so Home Depot, this now you can see that Home Depot looks very much like the group because it's the dominant theme in the group. And so now we look at the characteristics. We can see they're very similar. You can see the persistency of the uptrend and how it just keeps pulling back to the rising moving averages in price and relative strength. And you can use that to be able to initiate or add to your positions. So anyway, we don't have to say much more about that because it looks just like the group.
But this is very interesting, Bruce.
Yeah, Ramon, show us this one.
Mm-hmm. I'm looking, let's just look at the group first. So such a different picture for this group than any of the other groups or stocks that we've looked at before. And we are in the environment where the market is not behaving really well. But look at this group, a beautiful uptrend. We are above moving average. The volume signature confirms all of the moves. We're overcoming the previous point of the resistance where we had some kind of climactic stop in action. And then look at the relative strength. Not only we are above the moving averages, but we are making higher highs and higher lows, a definition of the uptrend. And there is a lot of momentum behind all of this moves to the upside. Look at the October decline in the market. We would never even guess that it was there. Obviously, the group has that characteristic of, defensive characteristic. We could talk about this, but maybe this is something that we should be looking during the times like this.
I want to point out that notice how when you get everything lined up in a bullish way. So if looking back at 2016, and you can see that you get a confirmed uptrend, price, relative strength, that all of a sudden the rally, the trend becomes dynamic. It starts to really accelerate and just go, go, go. And this is exactly what we're attempting to coordinate with these two ways of looking at the trend of the market. And so here you can see it happening again in 2018, where they get in gear on the upside and they would start rising and it becomes dynamic. Look at the dynamic quality of the rally that occurs after that. And that's because these institutions are just in love with this theme because it's working for them. Okay, we have one more stock, I think.
All right. And it's
Ramon, take it away.
Well, I really like the pattern of where, we have a consolidation on the moving average. It's just kind of like the price tries to go down. There is some selling, but it's somewhat marginal selling. There's not a lot of selling, and there's not a lot of result to the downside. So we love that. And it looks flat, as a structure. And we like that after the big rise, from the previous low. So a lot of the bullish characteristics here, also, with the lower volatility, and we're breaking to the upside. And look at this, guys, we are doing the same with the relative strength, so which is a really good sign.
Relative strength is like, I think of it like X-ray vision when you combine it with proper price analysis, both Wyckoffian and trend. When you put those elements together, I think that you have a very strong combination of important characteristics that stocks need to have. So that would be my message here. And I believe that, I know that we're going to talk a lot more about this in the future. Ramon, last thoughts before we go?
Stay safe, guys. Be cautious. Think tactically. Trade technically.
Wonderful. See you next time. Thank you, Ramon. Thank you, everybody.
Thank you, Bruce. Thank you, everybody. Bye-bye.